Today we're talking about the truth behind dollar cost averaging. Most people talk about it as it's a positive thing, but is it really? Let's do some math and figure out dollar cost averaging. Is it all it's cracked up to be? It's coming up next. Hey, this is Mel Stubbs. I'm a financial planner here at Christy Capital Management, and we like to do research on certain topics to help bring good information to you. Today I want to look deeper at dollar cost averaging. Does it work? Is it a good thing? Is it the best thing to do? Well, first, let's define what dollar cost averaging means. The definition of dollar cost averaging is the practice of investing a fixed dollar amount on a regular basis, regardless of the share price. Most notably, this is what people do with their TSP or their 401ks. As they get paid, they invest a certain portion of their paycheck on a regular basis. Now, as it relates to your contributions to your employer plan, this is really the only way you can do it. There isn't a lump sum option available. You have to put it in proportionally with each paycheck. So here's what's good about it. When you dollar cost average, you buy more shares of an investment when the share price goes down, and fewer shares when the share price goes up. Now, a lot of people, if you think back to 2008 when the stock market crashed, one of the reasons that allowed people to rebound more quickly was that they were able to continue buying at the lower prices. So when the stock market eventually came back, they owned more shares because they were able to buy more during that downtime, which in the end, brought their average cost per share down. So this makes sense. When the stock market goes down, I'm able to buy more shares, and thereby I'll have more shares later when the stock market rebounds. That sounds good. Therefore, dollar cost averaging is amazing. It must be the better choice. Well, hold on a second. Let's look at the other option. Now, the other option is lump sum investing. Let's say you've just sold a house, or maybe you just inherited money. Do you just go to put it in the stock market, just put everything in the stock market all at once in a lump sum? Or should you slowly put the money in over a year or two? Now remember, with contributing to the TSP or the 401k, you don't have this choice. You have to put it in periodically. But if you have a lump sum of money, should you just invest the whole thing, or should you hold some of it back and put it in slowly? Well, when the market is trending upward, lump sum investing works better. Dollar cost averaging misses out on some of those gains that you could have realized if you'd invested the full amount. Delaying the investment by spreading it out can really mess you up when the stock market's going up. Here's an example I found. If you invested a lump sum of money in the S&P 500 on the first trading day, January 2021, then you would have earned 29% return on your investment by the end of the year. If you split the money up into equal monthly payments on the first trading day of each month, you would have only earned 22% on that money. Because the market was going up, you should have lump summed it. Now, on the other hand, if you look at 2020, which was a much more volatile year, causing the lump sum investment to only yield 15% compared to a 27% return when you did the dollar cost averaging. So why is that? Well, because the market was down. That was when COVID happened, and there was the COVID crash, and it came back. You were able to buy more shares during the down months, so that when it rebounded, by the end of the year, you had a better return because you were able to buy more shares. So it seems like if the market is trending up, lump sum works better. If there's a downturn in the market, then dollar cost averaging works better. So which is more likely? Does the market tend to go up more, or does the market tend to go down more? Well, let's look at some numbers. Here is the historical S&P 500 index market returns starting in 1980. Now you'll see here in 1980 through 1992, there were 2 negative years, in 1981 and in 1990, and there were 11 positive years. If you look here, this is 1993 through 2008. Now you can see the dot-com crash of 2000, 2001, and 2002. You also see a large 2008 crash. But if you look, there were 12 positive years and only 4 negative years. If you look here from 2009 through 2021, you'll see there were 12 positive years with only 1 negative year. So if you're doing the percentages, there were 35 positive years out of a total of 42. There were 7 negative years out of a total of 42. So that means that 83% of the time, from 1980 through current, it's been positive. Now I know this is a simplification because we're only looking at end of the year total return, and it's not showing the ups and downs throughout the year. So the data makes lump sum investing better. So then why on earth do we talk so much about dollar cost averaging? Dollar cost averaging helps take the emotion out of investing. It helps us to continue investing the same amount regardless of what the stock market's doing. Now, Carl Richards, he's a thought leader in our field. He calls it a behavioral solution. And Michael Kitces, also a thought leader, calls it a regret minimization system. It's a way of helping people invest when they wouldn't ordinarily invest. Now, the math shows it's not the best way, but for many people, the best advice is the advice that people will actually follow. People are more likely to put money in periodically. For some people, that's really the only way they can do it because contributing through work is really all they do. So does this mean if you have a lump sum, you should just go put the whole thing in the market right now? Well, probably not. You should look at the market conditions. You should see where the market is currently and then make a decision if you should put it all in or not. But on the whole, if you look at the math, the market tends to go up a lot more than it goes down. And so getting your money in sooner works out to your advantage more times than not. I hope this discussion has helped you. If you're looking for a company to come alongside of you and help you with your retirement planning and your investment selection, please go to christycapital.com. Give us a call on the number on your screen. We would love to help you. Are you doing all you can do to assure your retirement has the best chance of success? Please reach out to us. This is Mel Stubbs. I'll see you on the next video. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used and if used correctly can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally. So seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.